I now hand the conference over to Mr. Prayesh Jain from Yes Securities. Thank you, and over to you, sir.
Thank you, Inba. Good evening, everyone. Hope this call finds you and your family in the best of health. At the outset, I would like to congratulate the management team of Gulf Oil Lubricants for a very strong performance amidst these tough times. From the management, we have Mr. Ravi Chawla, Managing Director and CEO, and Mr. Manish Gangwal, who is the CFO. We thank the management for providing us the opportunity to host the call. I shall now hand over the call to the management for opening comments, post which we will open the floor for Q&A. Over to you, sir.
Thank you, Prayesh. Good afternoon, good evening, good morning to all of you attending this Q3 call. Let me start by wishing all of you a Happy New Year and hope you are all safe. And on behalf of the GOLIL management, I'm delighted to share with you that Q3 has seen a significant improvement overall in terms of the Gulf and industry demand. And we are very happy to share, as we have announced, that this is another record quarter in terms of our parameters of the business compared to Q2, where there were also record created. Q3 has been a very, very good quarter. As I mentioned, the Gulf demand products, the range, the segments, we have seen a very good performance, which has enabled us to increase our volumes by 16%, and we have clocked in 33,000 KL this quarter. And as you have seen in the results, our revenues are up 14%, and similarly PBT is up 16%, 16.5%, and PAT at 14.5%. Definitely, we have seen that all our segment-wise strategy and the response to the segments has improved. And 16% growth is certainly 3 to 4 times the industry growth from what we are gauging. And revenue realization, the product mix has also had a positive trend. There is definitely some segments like the passenger car, which will definitely improve, but we have seen motorcycle and commercial vehicles doing very well, where we have got, if you take personal mobilities, close to a 20% growth in our volumes. There has also been a very good all-round segment-wise improvement right across from our bazaar to our industrial to the infrastructure segment. And happy to also share that OEM factory fill volumes, where we mainly have commercial vehicles, has also increased to cross nearly 35-40% growth over even last year levels. So that is very good for us. The channel business, which is one of the key pillars, recorded also the highest ever secondary sales and in the quarter. And we have also seen other segments, which are the franchisee workshops, the industrial distributors, which are very strong December and also the highest quarter. Again, I must commend the teams, our distributors, who have really worked very hard to ensure that Gulf is growing much faster than the market and competition. We had spoken of a lot of cost optimization. We continued that on all major line items, but we also invested in our brand in terms of the IPL, brand promotions, social media campaigns, and these continued. In fact, though as a percentage is looking lower, the last quarter we invested behind a lot of retailer and consumer-led campaigns, mainly IPL. We had a campaign called Gulf Ka Call, and for retailers and trade, we had special offers which helped. We have also seen that collections has picked up very well. Manish will talk about that later. There has been some increase in the raw material cost, but we are happy to share that not only Gulf, who has announced the price increases in the bazaar market, competition has started following that and announced their increases. And given the challenges we have on the cost, of course, B2C has a discipline, B2B is more formula-led, and that will happen. It is also at the back of looking at the demand conditions improving.
आपण ज्या व्यक्तीसोबत बोलत आहात त्या व्यक्तीने आपला कॉल होल्डवर ठेव.
Hello.
Apologies, sir. You may go.
No problem. So at the back of the demand conditions improving and looking at the budget where infrastructure and certain other announcements have been made, we think that setting up the double-digit growth that is going to come in the next fiscal, we will continue to see strong volume growths coming into the next quarter, and of course try to manage the band of margin that we have always targeted. So all in all, I think it's been a very good quarter. Again, to end with a note that it's been a record quarter for the company. We have always followed the philosophy that we try to make up and come back strongly as the demand conditions, especially this unique year that we have had. So it's been really gratifying for us, and we would like to thank you all for the support. I will hand over now to Manish to take us through some of the financial and other highlights which I may have missed. Manish, you can also cover the battery part. I think we'll leave it for you to cover these parts. Thank you.
Yeah, thanks, Ravi. Good afternoon, everyone, and Happy New Year to all of you who have joined this call. And I also hope that you are all keeping safe. And as Ravi mentioned, it was a very strong quarter for us, and overall from the business point of view. Also from the other financial parameters point of view, I would like to highlight that it was a strong quarter from improving our balance sheet further, and we are at an all-time high net cash position of more than 350 crore now. And I'm sure you will remember that when the year started, we were at around 200 crore of net cash, and now it's around 350 crore. So we have from working capital management side, at the end of this quarter, we were at one of the lowest point of working capital overall, around 85 gross days of working capital, which is again a very healthy sign that collections have improved significantly across sectors. And overall, also considering this, the board was happy to recommend the same dividend as it was last year as an interim dividend of 7 rupees, which is 350%. And that shows the confidence of the board on the business going forward. I would also like to highlight, as Ravi mentioned, that our battery segment, which we have been nurturing over the years, and it was doing very well, but this quarter and these 9 months have been a very good growth for our battery business also. And they have again broken many records and have become net cash positive, net bottom line positive for us after nurturing them for many years. So that's also a very healthy sign, and I think now we will take questions, Prayesh.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Ronak Sarda from Systematic Shares. Please go ahead.
Hello.
Yeah, we can hear you, Ronak.
Yes. Thanks for the opportunity and congrats on a good set of numbers. Sir, 2 questions. One, I realize, obviously your PV active filling and all will inch up, has already started in Q3 and will inch up further in Q4. So how should we look at capacity utilization currently and its effect on, the operating leverage which plays out? So, because I also understand gross margins will be under pressure due to increase in base oil. So, over the next few quarters, how should we, see the impact of gross margin contraction and the operating leverage?
Manish, you want to go?
Yeah, so we have sufficient capacity as far as, we have built the new plant, and in total we have 140,000 KL of capacity. And obviously, if the demand conditions are good, we will continue to get that operating leverage. We have to also appreciate that as the economy opens up and the market opens up, travel opens up, we'll have to spend more also in terms of reaching to the market and doing the activities, some of the activities which were not being done because of COVID. Overall, we have been always saying that while you are right that base oil is inching up and there is a input cost rising scenario for base oil, packaging material, everything. But we have taken price increases also to partly set off that. Plus, we will continue overall cost consciousness, which is there in terms of all our A&P and other expenses. travel, etc. will not be fully increasing. So we are quite hopeful that we will be able to maintain our guidance band of EBITDA, what we say 16 to 18% EBITDA margins. We should be in that band.
Sure. So, sir, what has been the price increase across different segments, if you can share that?
So it is market linked, and depending on, as you rightly said, different product categories based on the competitive scenario, price increase has been taken to offset part of the cost increases.
Sure. Okay. And sir, the usual breakup which you share between the B2B, B2C business and overall, CV engine or CV mix, personal mobility mix.
Yes, B2C, B2B ratio in this quarter has improved to 65-35 because the retail sales have been very good, and we would like to add that while the primary sales was very good, the secondary sale in B2C, our channel business, has been even better. So to that extent, there is a demand from the ground which is coming up, which is very good sign. And product mix wise, our more or less product mix has remained similar to Q2, which is the diesel engine oil has become 37%, 1% increase here and there. And personal mobility is in same 24%.
Okay.
And industrial is 15%, others at 24%. So nearly some plus minus 1-2% here and there, more or less the mix has remained similar.
Sure. Okay.
Within that, of course, the motorcycle has done very well. Passenger car has slightly not done well. I mean, it's still to pick up because metros are not fully open functioning yet.
Right. Yes. Perfect, sir. Okay. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Sabri Hazarika from Emkay Global. Please go ahead.
Yeah. Good afternoon, sir, and congratulations on a good set of numbers. So I have three questions. The first one is, if I look into your volume trajectory till this 9 months, and considering the fact that last year Q4 itself was affected by COVID during the month of March, it looks like that you would be probably ending this year flat in terms of volumes, FY21 versus FY20. So you mentioned that you were kind of optimistic on a double-digit volume growth. So on this base, probably if I consider FY21 to be flat compared to FY20, then also do you mean to say that you would be able to do a double-digit volume growth in this base for FY21 for FY22 as a whole? Is that right assessment?
Ravi, you want to take that or?
No. So, we, as you know, in the past years before you take the COVID year and earlier years, we have been growing double digit anyway, that in volumes.
Right.
So, obviously the base for the industry is going to be lower. We anticipate whatever estimates we have of the segments we are in, that the industry would be degrowing in the full year to the extent of 10-12%. That's our estimate, which they know very easily traceable. So if the industry is grown minus 10, 11, 12%, obviously for us next year we are obviously making the quarters have improved the performance. Quarter 4 is still to go, so we have to wait and watch. But we are seeing strong demand conditions for Gulf, and most of the players are there is a volume demand, and sectors are opening up, as you rightly said, OEM. So I think our endeavor has always been to look at 2 to 3x the industry growth rate. Sabri, you know that. So based on the normal trend, if the industry is going to grow maybe 4-5% next year, so we would definitely look at maintaining our 2 to 3x. But we'll have to wait and watch if there are more opportunities, and of course there will be challenges. So we are definitely our strategies and our plans are to ensure that we are 2 to 3x the industry growth rate.
Right. Thank you. Second question is on of course on the margin front. So you have been maintaining the 16 to 18% EBITDA margin guidance. So looking at the revenue growth, I think the margin trajectory, overall the EBITDA trajectory also looks optimistic. I just wanted to know if from a pricing perspective, I mean, you mentioned that you've taken a price hike recently. And I guess one of your competitors also mentioned that across the board there has been price hike to the extent of 3 to 5%, I guess. So your price hike was also similar if we consider it on a company level?
If you want to go on this?
Yeah, so as I mentioned in my previous question, that depending on product to product and segment to segment, depending on our strengths, we have also taken a price increase and ahead of many of the competition. Sometimes the price increase was taken in the mid of December. And of course, this takes some time to realize fully because there is a pipeline inventory within our warehouses and also at distributor end. But as a trajectory, yes, we want to maintain our margin management strategy. That's what we aim at. And we have to really see how base oil pans out going forward also. That's a critical variable which we do not know how far that is going to happen.
Right.
Our margin management strategy continues.
Right. If I look into the base oil market, so the base oil market started tightening, I think, somewhere from September, October onwards. And there was like broad-based increase in all kind of, you could say, specialty chemicals, which in probably clubbing base oil together with it. So there's been increase everywhere. But one school of thought is that once my GRMs broadly, the refinery margins recover, then the refinery utilization globally would go up and base oil prices should not go much as high as like in tandem with crude oil. There could be some softening of base oil prices. So do you agree that that can be the scenario over the next, say, 5-6 months, considering that GRMs and global refinery utilization improves? Or do you think that with crude oil also now reaching 60 and probably it might go even higher, then base oil will also continue to grow? So what is your internal assessment on base oil pricing?
So we have been highlighting this, that while over a longer period if you chart a multi-year chart of the crude and base oil, there is a symmetry. But in short-term demand supply condition of individual grades of base oil plays a pivotal role in base oil pricing. Right now, there is a sort of supply constraint in base oil, which is leading to base oil actually going up even before crude started moving.
Right.
So this situation we do not know. Yes, but as you rightly mentioned, as the refineries open up, many of them have taken shutdowns in these times, to just do their maintenance shutdown to use this period. As and when that capacity comes up, we also believe that the prices should stabilize at some point in time. But this is a question mark as to when and how. But depending on various grades of base oil, there is always, to that extent, a de-link from crude always. So it's not like in the short term it's following crude. It is over a longer period it follows crude.
Mr. Hazarika, may we request you to return to the queue, please? There are
Okay. Thank you so much. Yeah. Thanks and all.
Thank you.
Thank you. We'll take a next question from the line of Manikantha Garre from Axis Capital. Please go ahead.
Thank you for providing me the opportunity and congratulations on great set of numbers, sir. So just have 2-3 questions. First one is on the A&P. You mentioned that you had to increase the promotion costs because the market was opening up and all. So can you please provide what percentage of sales has been spent in the Q3 and 9 months?
If you want to cover the percentage, then I'll give a little more information.
Yeah, so this quarter we have ended up around 4% as A&P cost, which used to be usually around 6%, but this quarter it was 4%, high up from what we have spent in quarter 2 and obviously from quarter 1.
So directionally, this 4% will move towards 6% as market further opens up. Is that a right assessment, sir? That Q4 and early quarters of FY22 would be moving towards 6 to 7% then?
So it depends on many factors. And again, as I mentioned, competitive spend and the share of voice. Of course, the market has to open up. A lot of part of it is BTL activities. It's not only about ATL. So a large part of it is also BTL, and we have to really see when the market opens up or travel is freely done. Obviously, the BTL part of it will definitely go up.
So, just to add here, you see, in the beginning of 2020, we had got our brand track where actually we had shared with, I think, the investors that our brand has moved to a good number 2 position in terms of overall recall and consideration. So as the Gulf brand has gained, obviously we have to do a lot of activations, a lot of below the line, above the line. We have not only the India assets and the India below the line activations to do product wise, segment wise. We also have global associations which we have with Manchester United and with McLaren. Recently we signed with McLaren at global level. So I think it is a pragmatic use of investing in your brand, and as Manish mentioned, the share of voice. What are other people doing in this industry, and how do we get both our brand image and our messaging around our value propositions, also segment wise. And if you look at the overall use of media today, with what has happened now is you see social media assets are more important. So we will be looking at that. In fact, we do it every quarter. So based on whatever is required, obviously Manish mentioned that there have been the activations have not been very high because of travel constraints and other safety parameters. But as we see the economy opening up, we continue to backing our brand in the best way that we have been doing over the last decade or so. So this will continue as a strategy for us, a key strategy in the brand.
Understand. So my second question is on the battery business. We can please provide the revenues, EBITDA in Q3, and as well as throw some color on the new acquisition that you have done.
Manish, you want to go?
So as I mentioned, the battery business has clocked in more than 25 crore for the quarter, which is a very positive sign, and this is nearly giving us a of course on YOY basis it's nearly 40-50% growth. So in these COVID times, this is really I think a positive sign for us in terms of overall our battery strategy, which is working out. We are now quite happy to say that our battery strategy, which we started 5-6 years ago, is working out well. So, and as I mentioned, we have become net profit positive for the battery business as a segment. And so your second point, Manish?
Acquisition, the new acquisition.
Yeah, so I'm sure you have seen the announcement that we have taken a small minority stake in UK company, which is Indra Renewable Technologies, and they are into smart charging, EV charging, smart charging, and primarily focused on home charging solutions. They also have a technology which is V2G, which is for vehicle to grid, which is another facet of it. But primarily they are having strong presence in, I would say, UK market. They have nearly 5% market share there. And with this, we are getting an exclusive, tie-up for India, where we will be, whenever the opportunity is. Of course, we know that the opportunity right now in India is not there too much. But as and when the opportunity comes in, we will be happy to distribute and, play in this sector of providing EV infrastructure. And of course, we have our own distribution strength in India, which is a very positive, and we can leverage the brand and distribution strength to market and install these EV chargers, which are primarily home chargers. And home chargers in India will be a significant component of the overall EV charging space, because we believe that public charging will be more used as a top-up, and vehicles will be charged more at home in night, and then they will be used for the next days and next runs. So home charging is a very interesting space, and that's where these people have a very smart technology, and they have 5% market share in UK. So that's a nascent beginning we have done, and I think we have to keep exploring this sector as we move forward.
Understand, sir. Thank you so much.
Thank you.
Thank you. We'll take our next question from the line of Aditya Makharia from HDFC. Please go ahead.
Yes, sir. Congrats on a good set of numbers. I had maybe had a longer term question. We've obviously got into the battery segment about 3-5 years ago. Now we're buying, maybe small stakes in not startups, but EV chargers, which is a relatively new concept. So how do we really think of our business from a medium-term point of view? How much do we want to de-risk away from the, the oil, which is the engine oils? Is there a number you could, give us, or is there a thought process within the organization on the same? Thanks.
Yeah, so, Aditya, the thing is that we have shared this in the past also. The demand for lubricants, as per what we have estimated overall, and whatever you have the experts estimating, given the penetration of vehicles, and of course there are conversion of EVs coming in different forms of predictions, we have said that over the next 15-20 years, the demand is not going to come down for lubricants in India. Okay, in terms of replacement and the vehicle park and whatever estimates are there. So we will obviously continue growing our market share in that and various segments. And certainly as and when the EV value chain evolves, we are looking at opportunities. And the allied business for us, which is batteries, also looking at some adjacent areas there. And this would be the strategy and thought process. Obviously, Manish would like to add. Directionally, that would be our thought process, yes.
Yeah, no. So I think you are well covered. Everything is as a part of a longer term strategy, all these investments and allied business development. But we continue to believe that for the next 15-20 years, the overall lubricant market in India is going to go up only.
Okay, great. And just maybe another related question in terms of an M&A opportunity, what kind of size would you be open to looking at a very large acquisition, or would you just want to take minor steps or limited steps, let's put it that way, where maybe you do not want to stretch the balance sheet a lot? So how would you approach the future opportunities?
You are talking of M&A in the lubricant space or in the
non-lubricant space, essentially.
No. So we are open, but we are open to the M&A opportunities. We have net cash position which we want to gainfully deploy in the company back. But we are a consumer company, and obviously we would not like to dilute significantly our ROE and ROCE ratios. So keeping that in mind, we will be always looking at the opportunities both in lubricant space also, and also in the adjacencies like coolants, etc. Plus, if anything is in the battery or in EV space. But overall philosophy remains the same.
Got it. Congrats and thank you.
Thank you.
Thank you.
Thank you. We'll take a next question from the line of Abhisar Jain from Monarch AIF. Please go ahead.
Yeah, sir, congratulations for very good performance in Q3. So my question is on the capacity expansion going forward in the lubricant space. I believe there is a debottlenecking opportunity in the Chennai plant. So when are we expected to take that call as we on a quarterly basis continue to do a very good run rate in the volumes?
Manish, you want to go?
Yeah, so if the COVID was not there this year, probably we would have needed the capacity expansion even sooner than what we are estimating. But obviously, in next 1 to 2 years, we'll have to look at expanding the capacity in Chennai plant as well as in our Silvassa plant. But the blending capacity in a lubricant industry, you will appreciate, is still not a difficult task to increase. You can run the third shift and you can increase the capacity. It's more about debottlenecking in the filling lines and in terms of storage, etc., which is not a very significant capex, but we have to incur that over a period of next 2 to 3 years.
And sir, what would be the approximate capex number for this debottlenecking?
So we have been highlighting that our overall capex trajectory in a year will not be more than 10 to 15 crore. So I think in that range, if we continue to incur every year, we should be able to meet our next capacity target.
Sure, sir. And sir, another question was on the battery business. So since now you have sounded quite positive on the way the battery business has evolved and also turned net positive, So how do we look at the scale up there or the investments going forward into that business to make it a meaningful contribution, for our profitability?
So again, we have highlighted in our earlier calls that we are looking at localizing the production, and we are in advanced stages with few people here in India to localize our batteries, which will take around 9 months to 1 year if everything goes well.
So we're just looking for some more color in terms of what kind of investments might go and what could be your targets in 3 to 5 years for this business.
Again, this is not a very high capital intensive business in terms of putting up our own greenfield or buying out some capacities available. So the earlier indication we had given was that the overall capex will be less than 70-80 crore rupees, and we continue to believe that from the capex point of view. Of course, in terms of growing the business, we are doing very good in terms of overall growth, even in these times, in tough times. So we want to take it to the growth levels which we had aspired earlier, at least 200 to 250 crore over a period of next 2 to 3 years.
Okay, sir, understood. Thank you so much and best of luck.
Thank you.
Thank you. Our next question is from the line of Jitendra Khatri from Quantum Advisors. Please go ahead.
Sir, I wanted to know if it is possible for you to indicate to us drain intervals across segments. So, like, what will be the drain interval for a two-wheeler or for a tractor or a truck? Just broad figures are also okay.
And so you see, in the case of commercial vehicles, the higher end oils, which we call the thinner oils, which are the vehicles last 7 to 8 years, the drain interval is between anything between 50 to 60, 70,000. Though the rating is far higher, so that is the range which normally it gets changed. And there are products we have which are 80,000, even higher than 80,000 for the engine oil. The gear oils and all are sometimes multiples of that, and the other products.
Okay. Okay.
So cars, normally people, different types of oils are there. It can be a long session, but basically you see there are some high-end cars which don't require much oil change, even 8 to 12 months. But generally, if you take the mass cars, they would require an oil change every 3 to 4 months, depending on what you run. So there are various things. Motorcycle, again, there is kilometers. 3 to 5,000 kilometers is what people would normally change at.
And in cars, I can safely assume 10 to 12,000 kilometers, correct?
Depends on the car. Again, we'll have to. It's a detailed discussion if you want to get into model and type of oil.
Okay. And sir, once the market moves to synthetic or this BS6 oil, how do you see this stretching up?
BS6 oil, whatever we have seen, the oil is definitely a superior oil because it has to maintain the emission and the various other requirements. So the drain interval is similar to the earlier grades which were there in the mineral oils.
Okay.
But when you look at synthetics and all, the kind of pure synthetics and all is very low percentage of the total market as we see it.
Okay.
But synthetic oils, the definition is very important. You have a chemical synthetic and a mineral-based synthetic.
Yeah.
So based on that, it's still a very low percentage in car and two-wheeler. Car is the main area where it is coming in. So I guess synthetics will have a higher drain interval, but the pure synthetic, which is the most expensive, is very difficult in India because the affordability comes in. So you have more mineral semi-synthetics, and that's a study we are under. We are also trying to define, but ballpark, it's still single digit in terms of overall market.
Okay. So do you think that the recovery from realizations, semi-synthetic oil, will more than outpace the loss of volume due to drain intervals stretching out? That is the question, basically.
See, Manish can add here, but you see, automobile industry, if you don't take the last 2 to 3 years where there was certain factors, BS6 coming, BS4 to BS6, then whatever happened in COVID, the general automobile industry, because India is a market where the penetration is so low in all the vehicles, that. The industry will grow 6 to 7% when you talk of new vehicles. Okay. If you take a larger period of time. and generally lubricants are growing at 2 to 3%. So you see that drain interval has already got corrected in terms of the longevity of the products. So I think this trend will continue for some time. Of course, we are hoping that the growth rates pick up next year for new vehicles, and also there are lots of measures the government is taking in terms of having a flexible and optional vehicle scrappage based on tax regimes. Then obviously desire for people to get entry-level cars, bikes, rural growth. So I think more or less, the improvement in the technology is getting offsetted with the growth in vehicles that should come.
Yeah. And lastly, only on the tractor segment. So what is the usage like? Not in terms of drain interval. Is there a large unorganized market there as well, or a lot of crowding is there, or these guys?
I think the older vehicles do tend to use oils which are cheaper, and maybe, but largely the market is now moving towards the organized sector. And tractor has done so well in the last 1 year, and we also got ties with Mahindra, Swaraj, and our own tractor oils.
Yeah. Right.
So I think it is a seasonal product because the sowing and other harvesting, all the tractors, those are seasonal. You have a couple of seasons in a year. And there is definitely the larger players and distribution. Also the products that are available for all the tractor manufacturers are very specific products which have very good, they maintain the engine and give the performance. So I would say, in fact, the tractor segment is quite an involved decision. And though there are obviously price players and some unorganized sector, but the trend shows clearly that it is definitely getting, the OEM plays an important role, the distribution, the below the line, and we continue to grow very well in this segment, and we believe that unorganized sector is there but not that high.
Yeah. So thank you so much. Really appreciate your efforts to disclose so much about how the industry works.
Thank you, Jitendra.
Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, you may enter star and 1. We'll take a next question from the line of Tanay from MK Global. Please go ahead.
Hi, sir. Congratulations on a good set of numbers. I just want to quickly ask about the Indra Renewables stake that was picked up by a parent company. Was Gulf Oil Lubricants also involved in picking up any stake, or was it only the parent company that picked up some stake?
So in this board meeting, Gulf Oil India has taken 7.85% stake in the company.
Okay, great. Thank you so much.
Thank you.
Thank you. Any participant who wishes to ask a question may enter star and 1. Our next question is from the line of Prayesh Jain from Yes Securities. Please go ahead.
Yeah. Hi, sir. I have just one question. This was regarding to the export business. How is that shaping up now with some of the economies opening up, and what is the trajectory that we've seen in Q3, and how do you see that business shaping up going ahead?
Yeah, so exports have actually done very well in this quarter, and as you rightly mentioned, as the economies are picking up, the demand is improving there also. Our exports are mainly to Southeast Asian countries, and there the demand conditions have improved.
What is the share of exports in this quarter or 9 months, if you can share?
No. So it's usually very low for us. We have been doing only 3 to 4% of our overall volume in export. Sometimes in a good quarter it can be 5%, in that range only.
Okay. All right. That's it from my side.
Thank you.
Thank you. Anyone who has a question may enter star and 1. Our next question is from the line of Nikhil Niyati from Ardeco. Please go ahead.
Congratulations on your good set of numbers.
Thank you.
So my question is related to the commercial vehicle segment.
Sorry to interrupt. Mr. Niyati, if you're on a speaker mode, can you switch to handset, please?
Yeah, sure. Hello, am I audible?
Yes, sir. Thank you.
Yeah. So my question is related to the commercial vehicle segment. Sir, would it be possible for you to give a breakup about how the commercial vehicle segment turns up in terms of what is the volume mix in terms of CVs are more than 3 years, like CVs more than 3 years and CVs less than 3 years, like how it pans out?
No, we will not have that information in terms of the cut you want. So, Nikhil, we probably can take that offline. We don't have it at that cut of 3 years.
Okay, sir. Thank you.
Thank you. Our next question is from the line of Abhisar Jain from Monarch AIF. Please go ahead.
Yeah, sir, thanks for the opportunity again. Sir, just wanted to understand the competitive intensity on the lubricant side. I think we were witnessing a little bit, aggression from one of the top private players, and also some correction in their pricing for the commercial vehicles portfolio in their recent release of the results. So, just wanted to get a sense from you that we remain undeterred in that sense and continue to believe that over the next 3 to 5 years we can still outperform the industry in the way that we have been doing in last 5.
Yeah, so Abhishek, as I've been telling, we have been sharing, we have a segment-wise strategy. So based on our strengths, our brand distribution, our products, what we believe will help our growth, we have been actually, calibrating that over the many years now. Okay, and we obviously keep evolving based on what competition is doing, how the consumer wants, and how the market and other such things are there. I think there are many segments where we are now clearly well positioned, and we are able to, obviously there is always competition doing different things. People simplified their offers during COVID. People will look at their own position as to where they have a strength. But we will be continuously focusing on our strengths in each segment. And as we look at each segment, to give an example, if our reach and distribution in a segment is strong and we can grow our reach even more, we'll continue doing that. There's urban, rural, there's product portfolios. So different segments have different competitors. Would not like to comment on what others are doing, but we are quite clearly focused to take each segment, and based on our strengths, our value propositions, our distribution and our goals, we continue to being on the 2 to 3x growth mantra for the overall industry. And in certain segments, we have to look at, for example, we have been trying to increase our share in the passenger car motor oil, where we are low. So we would look at that. Similarly, in commercial vehicles, you see LCVs are doing very well now, but we also look at how we can grow in other segments where we are not strong. We have entered a tie-up with Piaggio in three-wheeler commercial. In tractor, we have tie-ups with Mahindra Swaraj. We are also looking at our own tractor oils. And rural distribution, we have been growing a lot. Over the last 3-4 years, we have got stockists now, especially for rural. So I can quite go on each segment, including B2B and industrial. We have infrastructure customers. So we have got a very, very detailed segment-wise outlook, and we have teams who focus on this. And I believe that is also important as we look at things. Yes, there will be other people calibrating their, pricing, etc. But for Gulf, we believe obviously with the brand strength, distribution strength, and our focus strategy, we will continue looking at healthy growth of 2 to 3x the market.
Right, sir, right. And sir, just one more follow-up on this. If you can, give say some indications that do we have a plan that over the next 5 years, our say the industrial and the the B2B, which is more like non-auto, should be at any given percentage of the lubricant business? Do we have any goal like that, sir?
Yeah, so we have lower market share in industrial and PCMO. So that is definitely an area of strategy to improve that going forward, much faster.
Okay, and sir, any number there for the next 5-6 years where you would want it to be in terms of percentage of revenues of lubricant business?
I think overall we are wanting to grow both the current strength and that. So definitely the former which I mentioned, we want to grow much faster than the 2 to 3x.
Understood, sir. Thank you so much, sir. Thanks a lot and best of luck.
Thank you so much.
Thank you. Any participant who wishes to ask a question may enter star and 1. As there are no further questions from the participants, I now hand the floor back to the management for closing comments. Over to you, sir.
Yeah, thank you, ma'am. I'd like to thank all of you for your time on the call. We have tried to answer the questions to the best of our ability. I would just like to say that the quarter three and the teams are working, and our channels and all our partners are working very hard to make the comeback. And quarter four again, as was a lower base last year, so we hope to continue seeing the external environment, which is good demand conditions for Gulf and overall. So that augurs well. With the challenges we have expressed, we will obviously try to pace ourselves and take the actions required. Given the GDP that is going to be double digit in the fiscal year ahead, I think that's very encouraging. The infrastructure investments are also very encouraging, and we are hoping that the double digit GDP growth will help the lube industry also get a 4 to 5% growth next year, and in some segments maybe better than that. So hope to share with you and be with you after the next quarter. Thank you so much, and stay safe, and see you soon. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Yes Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.